If you had $100,000 to invest right now, would you go all in on high growth or lock in stable income? Because the ETF you choose, QQQM or SCHD, could make or break your retirement timeline. One of them has delivered massive returns, the other provides dependable cash flow. But here's the twist. Most investors are picking just one, and that's a mistake. There's a smarter way to invest a strategy that uses both funds to maximize your upside and protect your future. It's a little-known approach that could help you retire years earlier, and I'll show you exactly how it works later in this video. QQQM and SCHD are two of the most popular ETFs right now, but they're built for completely different missions. One is designed for rapid growth, the other for long-term income. So how do you know which is right for your $100,000 investment? In this video, we'll break down both fund strategy, holdings, performance, risk, and taxes so you can see exactly how each one performs in the real world. And if you stick around, I'll show you a powerful strategy that combines both QQQM and SCHD, a method that could accelerate your retirement timeline faster than using either fund alone. Let's start with the ETF built for speed, QQQM. This fund tracks the NASDAQ 100 index, which means it's packed with the biggest and fastest growing companies in tech. We're talking about names like Apple, Microsoft, Nvidia, Amazon, and Meta. Companies that have reshaped the world and driven massive gains over the last decade. QQQM was created as a lower-cost alternative to QQQ, offering the same exposure with a slightly lower expense ratio of 0.15%. That may not sound like much, but over 20 years, even small fee differences add up. This ETF is all about capital appreciation. It doesn't focus on dividends. In fact, its dividend yield is usually under 0.7%. So if you're looking for income, this probably isn't your top choice. But if your goal is to grow your wealth as much as possible over time, QQQM delivers exposure to some of the most innovative and profitable companies in the market. There's one catch though: volatility. Because QQQM is so tech-heavy, it tends to swing harder than the broader market. In bull markets, that's a huge advantage. But in bear markets, it can mean steep drawdowns. Still, if you've got time on your side and can handle short-term drops, QQQM gives you the potential to massively grow your portfolio. In short, QQQM is like the gas pedal of your portfolio. It's not about slow and steady, it's about speed. And in the early stages of building wealth, that kind of growth can be a game changer. If QQQM is the gas pedal, then SCHD is the cruise control, steady, reliable, and built for the long haul. SCHD stands for the Schwab US Dividend Equity ETF. Unlike QQQM, this fund focuses on high-quality US companies that have a strong history of paying and growing dividends. That means you're not just depending on the stock price going up, you're also getting paid along the way. Its top holdings include PepsiCo, Cisco, Amgen, and Coca-Cola, companies with stable earnings and strong cash flows. These aren't high-flying tech stocks. They're solid, well-managed businesses that return value to shareholders through dividends. The dividend yield typically sits around 3.5 to 4%, which means that a $100,000 investment could generate about $3,500 to $4,000 a year in passive income. For many investors, especially those nearing retirement, that steady income is a huge advantage. SCHD also has an ultra-low expense ratio of just 0.06%, making it one of the most cost-effective dividend ETFs out there. And while it may not match QQQM's explosive growth in bull markets, it often holds up better when things get rough, thanks to the stability of its underlying companies. This ETF isn't about trying to beat the market with flashy gains. It's about long-term wealth preservation and dependable income. If you're focused on financial security and minimizing volatility, SCHD makes a strong case. But here's the real question. What happens when you actually put $100,000 into each of these funds and let them run? You've just seen how different these ETFs are. But what if I told you the smartest move might be using both? Stick around, because later in this video, I'll reveal a strategy that combines QQQM and SCHD, and it could be your fastest path to early retirement. Let's talk numbers, because past performance gives us a glimpse into what QQQM is really capable of. While QQQM itself launched in 2020, it mirrors the NASDAQ 100 index, which has over 20 years of historical data. From 2013 to 2023, the NASDAQ 100 delivered an impressive compound annual growth rate of approximately 14.7%. That means if you had invested $100,000 in 2013, your portfolio would have grown to around $392,000 by 2023, nearly quadrupling your money in just 10 years. That kind of return blows most broad market ETFs out of the water. But here's the trade-off: volatility. In 2022 alone, the NASDAQ 100 dropped by more than 32%. That's a gut punch for many investors, especially if you're watching your portfolio every day. But if you stayed in the game, 2023 brought a solid rebound. That's the pattern with QQQM. Big swings, big rewards, if you don't panic. Historically, the NASDAQ 100 has outperformed the S&P 500 over nearly every 10-year period since the 1990s. But it also comes with sharper drawdowns. That's why QQQM works best for investors who can ride out the storms and think long-term. And one more thing. QQQM's lower dividend yield means you're not getting much income while you wait, but the capital appreciation is what drives this fund's power. It's a bet on innovation, tech dominance, and America's most influential companies continuing to lead. Still, not every investor wants to deal with that level of risk. Now, let's see how SCHD stacks up when we run the numbers. Over the 10-year period from 2013 to 2023, SCHD delivered a compound annual growth rate of around 11%, including dividend reinvestment. That's not as flashy as QQQM, but it's still a very solid return, especially when paired with lower volatility and consistent income. If you had invested $100,000 into SCHD in 2013, your investment would have grown to roughly $287,000 by 2023. And here's the key. A good portion of that growth came from dividends, not just price appreciation. SCHD typically yields between 3.5% and 4%, which translates to $3,500 to $4,000 in yearly passive income on a $100,000 investment. That's money you can actually use to cover bills, reinvest, or just breathe easier in retirement. One of SCHD's greatest strengths is its stability during market downturns. While it won't protect you from all losses, it tends to hold up better than growth-heavy ETFs like QQQM. In turbulent years, that stability matters, especially if you're withdrawing income or don't want to sell during a dip. And unlike many dividend ETFs that chase high yields, SCHD filters for quality companies with strong balance sheets, durable business models, and reliable dividend histories. That helps maintain performance without sacrificing safety. SCHD may not win the race in a bull market, but when the goal is financial freedom with peace of mind, it's hard to beat. But now let's take this a step further. What happens when we zoom out and look at risk, taxes, and investor profiles to decide who each ETF is actually best for? So far, we've focused on performance. But choosing the right ETF isn't just about returns. It's also about how much risk you're comfortable with and how taxes affect your outcome. Let's start with risk. QQQM is more volatile. Its beta is typically above 1.2, meaning it moves faster both up and down than the overall market. That's great during a bull run, but brutal during a crash. If you're the kind of investor who panics when the market drops 20% or more, QQQM might not be for you. SCHD, on the other hand, has a beta closer to 0.9, meaning it's less volatile than the broader market. That makes it easier to stick with during rocky periods, and sticking with your plan is half the battle in investing. Now let's talk taxes. QQQM's gains mostly come from capital appreciation, so you'll likely owe capital gains tax when you sell. But if you hold it in a Roth IRA or 401k, that tax hit can be completely avoided. SCHD's dividends are often qualified, meaning they're taxed at the lower long-term capital gains rate, but they're still taxed in a regular brokerage account. That's why many investors prefer holding SCHD in tax-advantaged accounts, where the dividend income can grow without being taxed annually. So which type of investor is each ETF best for? QQQM is for younger, growth-focused, long-time horizon, willing to handle volatility. SCHD fits better to income-focused, nearing retirement, prefers stability and cash flow. But what if you didn't have to choose? What if there was a way to combine both using QQM to build wealth fast and SCHD to lock it in? Here's the strategy smart investors are using, and hardly anyone talks about it. It's not about choosing between QQQM and SCHD. The real move? Use both, but at the right time. Early in your investing journey, your biggest advantage is time. That's when QQQM shines. With its high-growth tech exposure and strong long-term returns, it gives your portfolio the power to compound fast. If you're in your 20s, 30s, or even early 40s, this is when you want to lean into growth. Let's say you invest $100,000 into QQQM for 20 years, and it grows at a conservative 14.7% annual rate. After 20 years, you'd have around $2 million. But once you've built that base, you need change. At that point, it's not about chasing more growth, it's about protecting what you've earned and creating reliable income. That's when you switch to SCHD. By moving your capital into SCHD, you can start generating $70,000 to $80,000 per year in passive dividend income based on current yields. That kind of income can fund your lifestyle, reduce the need to sell shares, and even help you retire years earlier than expected. But here's the catch. You have to make that switch during a bull market when QQQM has gone up and your portfolio is showing gains. Don't wait until a bear market slashes your balance. The power of this strategy lies in moving from strength, not from weakness. This approach lets you maximize growth early and secure income later, a smart, disciplined path to financial independence. If you found this breakdown helpful, there's more waiting for you. Click to watch my video on the best Schwab ETFs to build long-term wealth, or check out the one on dividend stocks that pay weekly income. Perfect if you're aiming for consistent cash flow.